Okay, let's start. Chapter 10 is about accounting principles and policies. Now you have to be aware that principles and policies are different. Yeah. Principles is more about rules how to record transactions in the accounting books. The policies is more about rules how to present financial statements. Okay. Once again, principles here is rules on how transactions recorded in the accounting books. Yeah. Meanwhile, accounting policies is rules on how to present financial statements of the business. This is about how your chapter 9 is presented. Yeah. So that is policies and principles. That's the difference between these two. Okay. Now, let's start on learning about accounting principles. Accounting principles, I actually summarize all the informations in the books, yeah, into a very easy sentence for you to understand, yeah. Because when you read in the books, it's sometimes sentences are difficult enough for us to absorb and to understand. Okay, so I made this summary or revision so that you can study this anytime and easier for you to recall. Okay, number one, accounting entity or business entity. What is actually accounting entity or business entity principles? This states that the business and the owner are treated separately. The business and the owner are treated separately in the accounting records. Okay, so whatever the owner did and whatever the business did will not going to be joined and then recorded together. You must be able to separate which one transactions made by the owner for the owner or transactions made by the owner for the business. Is that clear? Clear, yeah? So, for example, treatments of drawings made by the owner is recorded in the capital part of the statement of financial position. Now, we have learned about accounting principles, accounting equation, sorry. A equals to liabilities plus capital, yeah? Please do not forget this, okay? Assets equals to liabilities plus capital. Now, transactions in the business, they are different, yeah? They are divided into two, okay? So, transactions will be divided into two. The one is transactions for the business. And the second one, transactions for owner. Okay. Why is it different? Okay, so number one, transactions for the business. The second one, transactions for the owner. It means the second one is now, yeah, transactions made for the business or transactions made for the owner. Now, transactions made for the business will be recorded in these two, A and L, assets and liabilities. That is for number one. Yeah. Meanwhile, every single transactions owner made to the business, yeah, it will be recorded under capital. For example, owner deposit money into the business as additional capital. It will be recorded as capital, yeah, inside the capital part. Another example, the owner took assets from the business for personal use. Yeah, it means the owner took something from the business and then use it for personal use, and it also be recorded in the capital part. So every single transactions related to capital, related to owner, will be affecting capital. Once again, it will be affecting capital. Yeah, as well as the asset is collateral damage. Yeah, I mean collateral effect. For example, the owner took goods from the business, so asset will be decreased, and the other one will be capital decreased. Yeah. Okay. This is the example. The treatment of drawings will be recorded in the capital part. Yeah, in the capital part under statement of financial position. We have learned about statement of financial position in chapter 9. Yeah. Okay, up until this part, do you have any question? Oh yeah, okay. So that's how the statement is about accounting entity and business entity. And by the way, I present this sentence is the sentence or language that is usually been used in the IDCSE. Yeah, so you get familiar with that. Okay. Number 2, duality. Every transaction has two aspects involved, the giving part and the receiving part. Okay, it is represented in the double entry system where debit and credit will always be affected with equal amounts. Okay, so that is duality. Okay, every single transactions will affecting debit and credit to be equal. Yeah, that is duality. Clear, yeah? Clear? Any question? Next, money measurement. Money measurement is one of the principles that really often appear in IGCSE question. So please pay attention very carefully. Yeah. Money measurement states that only items that can be measured in money terms that will be recorded in the accounting books. Okay. All items that can be measured in money terms that has money value that will be recorded in the accounting books. Okay, for example, premises, inventory, trade receivables, all of them can be measured in money terms. So we can record that in our accounting books. That is why you always see premises, inventory, and trade receivables in the transactions of the accounting books. Yeah, and you will see that also in our statement of financial position. Yeah. Now, the next question is there any items that cannot be measured in money terms, but it brings benefit to the business? Yeah, it brings benefit to the business. It is valuable to the business, but we cannot measure that with money terms. Yeah. Now, those kind of items cannot be recorded in our books, in accounting books, cannot. Okay, because we cannot value that in money terms. Now, example for that is leadership skills. Yeah, loyalty. We cannot we cannot measure loyalty of our customers, of our employees, of our CEOs and managers. Yeah, we cannot actually measure that with money and convert that into money value. Cannot. Yeah, or even appearance. If you are in production house business, appearance as an artist, yeah, appearance is really important. It's valuable. Yeah, does this person is handsome or pretty or attractive, yeah, sweet or whatever it is, yeah, it is valuable to the business if you are in the production house, yeah. But you cannot actually put in appearance in our accounting books. We cannot measure it in money terms, yeah. So leadership skills, loyalty, appearance cannot be measured in money terms. So they cannot be recorded in the accounting books. You will never going to see that in statement of financial position. Yeah? But once again, it brings values to the business. We sometimes call it an X factor. Yeah. Any questions so far? Any question? No? Clear, yeah? Wisely, I want to see your face, please. Thank you. Next is realization. Realization is revenue recognized when the ownership of the goods or service has been passed to the customer. Once again, this is realization of revenue. Yeah, this is realization. And realization is about revenue or income. What does this means? Revenue is recognized. We recognizing our income whenever the ownership of the goods or service has been passed to the customer. Now this one, yeah, has been passed to the customer. So it means the goods or services have been delivered to the customer. Yeah. What is the example? The example, let's say Lynn. Yeah. Lynn purchased goods from Warren. Lynn purchased goods from Warren. Warren said, or Warren informed that he will deliver the goods 1 week later. Now, you might sometimes familiar with the word of pre-order. Yeah, pre-order, yeah. You sometimes familiar with that pre-order of, let's say, iPhone 13, yeah. Let's say Samsung S22, yeah. So when you are pre-ordering goods, okay, it called, we cannot, as the seller, we cannot recognize the revenue yet. We can never record that as our revenue in our books. We cannot recognize it. Yeah, but we will recognize that as our revenue, yeah, when we have delivered the goods to the customer. Clear? So in this case, Lynn purchased goods from Warren. Now let's say it is on 1 January. Yeah. Warren informed that he will deliver 1 week later, which is on 7 January. Okay. Now this means that Lynn cannot recognize. When I say recognize, it means recorded, yeah? So Lynn cannot recognize or recorded the sales as revenue yet. Yeah, Lynn cannot recognize or recorded the sales as revenue yet on the 1st of January. Okay, Lynn recognized or recorded the sales. Kok Lindsay? Warren, yeah? The seller is Warren. Apologies. Recognize or recorded the sales as revenue on the 7th. Okay, now pay attention very carefully. Lynn purchased goods from Warren on 1 January. Warren informed that he will deliver the goods on 1 week later, 7th of January. So the conclusion is Warren cannot recognize or recorded the sales as revenue yet on the 1st of January. Why? Because the goods has not been delivered to Lynn. Hasn't yet? But when Warren deliver the goods to Lynn, which is on 7th of January, then Warren will transfer this or we called it as prepaid income. Yeah. So we receive the prepaid income and we recognize it as sales. Yeah. And then it is stated on the 7th of January. Okay. Once again, Warren can recognize the sales as revenue on the 7th of January because the goods has been passed to the customer. Yeah, the goods have been passed to Lynn. Okay, and please also be reminded that this one is also very often questioned. Okay, so for any question, is that clear? Clear, yeah? Because after this, we will study about income that we receive in advance, yeah, and then, but we will recognize it later, yeah, in chapter 11. This will connect it to chapter 11, yeah? Next, consistency. Consistency is accounting principle used in the business must be the same or consistent, must be the same or consistent from year to year. Yeah, it means that any accounting policies or rules or method, yeah, any accounting policies or method used in the business must be used consistently and cannot be changed from year to year. Okay, so in the future we will study about chapter 12 and another chapters, yeah, where we have to choose method on solving the case. Okay, now usually the business, after choosing one method to treat one of the assets, the company or the business will use that method for years. Okay, we cannot change the method from year to year. Let's say Year 1, we use method A. Year 2, we use method B. And then year 3, we use again method A. And then year 4, go back again to method B. Cannot do that. We cannot do that. Yeah. So that is why consistency is one of the policies. Okay. Because if we change rules, if we change method, we cannot make comparison to our income statement or statement of financial position. It is really important that you are using the same method. So whenever you are analyzing your income statement or statement of financial position from year 1 with year 2, yeah, it is more reliable because you are not changing the rules. Yeah, but when you're changing the rules, now analysis will become biased. Yeah, is that clear enough? Consistent. Yeah, you have to be consistent on using accounting methods. Next, accrual and matching. Accrual and matching, another accounting principles that always, yeah, not often, but always occur in the accounting, in the IGCSE, yeah. So what is actually accruals or matching? The word is matching. So we actually is matching between something and something, yeah. And what is that something? The revenue of the accounting period must be matched with cost. Once again, revenue must be matched with the cost of expenses, cost or expenses, yeah, of the same period to calculate accurate profit. Now, I want you to remember income statement, yeah. Remember income statement, yeah. We start with sales and then followed with cost of sales, where you are putting all of the expenses of bringing the goods to the business, yeah, cost of the goods that you sold. And then you add another revenues, yeah, in the statements. And then lastly, you are listing all the expenses of the business. At the end, you will get profit. That's what you did in income statement, right? So basically what you did is matching between all the incomes that the business has, and then all the expenses that the business has, and then you match them together. Total income minus with total expenses, yeah, and then you will get accurate profit. Okay, so this is actually accruals and matching principles talked about. Yeah. Now, the revenue of accounting period must be matched with the cost. Now, the next sentence is really important. It said on the same period of time. Now, in the reality, now this chapter, this number 6 principles will be connected to our next chapter, which is chapter 11. Okay. Sometimes in reality, when you are paying expenses, it's not always on the same period. For example, sometimes you have to pay rent expense for more than one accounting period cycle. One accounting period cycle is 1 year. Sometimes you have to pay rent for, let's say, 11 months. 18 months, yeah, 11 months, 24 months, or maybe 3 years, or maybe 5 years. Okay, now, it means when you are trying to make income statement, you have to match or adjust the income and the expenses to be only happening in that current period. Another example, water expense. Imagine water expense, yeah? Water expense is an expense that you must use first and then build later. Am I right? Water expense. So the water company, or we call it here Aetra, if you ever know. So the water company cannot charge you before you use that water, because there's a what is it called, a meter, yeah, to record how much cubic water that you use. After usage, then they can bill you with the invoice. So it means usage on January will be billed in February and will be paid in February. Usage in February will be billed in March and paid in March. Yeah. Usage in March will be paid in April because it will be billed in April. Now, so on and so forth. And then we are at the end of December. On December, the company used the water, but the bill will come on January next year. Now, the problem is the expenses of water has been appeared in December, but we are not paying it in December. We will paying it in the next accounting period. So how are you going to record that water expenses? The water expenses that must be recorded in the income statement is still 12 months of usage, even though you haven't paid it full. Clear, yeah? Because you have to match expense and revenue on the same period of time. If the revenue that you state is for 1 year, you have to make all the expenses and adjust all the expenses into 1 year as well. And we will study more about this on chapter 11. And this chapter 11 is a little bit hard. So I want you to understand the case first, yeah, the concept first. Okay, the concept about accrual and matching, or sometimes income and expense that we paid or receive is not for the full accounting period. It may be more, it may be less. Okay, and then our job is to match it, to adjust it. Clear enough? Am I make sense to you? Heidi, do you understand what I mean? Clear, yeah? Raphael, is it clear enough? Raf?
I think so, Miss.
You think so? Okay. It's okay because I will discuss this more details on chapter 11, yeah. But the point on chapter on accrual or matching principles is this, yeah. Revenue and expenses must be matched together, but it has to be on the same period of time. If your revenue is from January to December, your expenses must also be from January to December range of time. Okay. If your revenue is from January to March, then your expense must also be from January to March. What if you have an income or expenses that represent from January to June, and you cut it, yeah? You cut it so that expense and income just only for January to March. So that's the main focus of this principle. Okay, you have to show the same period of time, yeah, so that it will be accurate for calculating profit. Okay, next, yeah, prudence. Prudence is also one of the accounting principles that always occur. What is actually prudence? Prudence is to ensure that profit and assets are not overstated, as same as loss and liabilities are not understated. Now, in reality, yeah, a lot of company, a lot of business that is trying to make the assets and profit look bigger than it's supposed to, and loss and liability look lower than it's supposed to. Okay, in reality, it happens. So actually, in the accounting rules, it is not allowed. We have to be as prudent as possible. We have to be as true as possible. Yeah, we cannot. Yes, James, you can go to the toilet. Once again, we cannot present assets, profit, loss, and liability not as true as it is. Yeah, we have to make sure assets and profit are not overstated than it's supposed to, and loss and liabilities are not understated than it's supposed to. Do you understand the word overstated? It's bigger than it's supposed to, yeah? Understated, lower than it's supposed to, okay? Now, example. Inventory must be valued at lower of cost and net realizable value to avoid overstating value of inventory in the total assets of the business. Okay, inventory is asset. When the inventory is broken, yeah, or damaged, when the inventory is broken or damaged, comma, then it must, now this is the continuation, yeah? So inventory, when the inventory is broken or damaged, it must be valued at the lower of cost and net realizable value to overstating value of inventory in the total assets of the business. So it means you have to choose which one is the lower or the lowest value between cost and net realizable value. What is actually net realizable value? We will discuss this later in the next page, yeah, next page, okay? So when inventory is broken or damaged, you cannot record the inventory as it is, as the cost price. You have to compare between two values. Yeah, which one is the lowest? If the cost is bigger than the NRV, then you have to choose the NRV. If the cost is lower than the NRV, then you have to choose the cost. Yeah. Warren, are you talking to someone?
Yeah, miss, miss. I just talked to someone, miss. Ada main ba, miss?
Okay, continue, yeah? Sebentar ya. Okay, let's continue. Going concern. What is actually going concern? Going concern is just like what it said, yeah? Going concern, we are concerning about something, yeah? We have to be concerned about our business, yeah? So what it has, what is it has to do with our principles is that every single business, yeah, every single business must believe that it will continue to operate for indefinite future. So when we are in the business and we are building a business, all entrepreneurs, all business must have this belief that the company will always be going to operate for indefinite future, for unlimited time, yeah, always, forever, yeah. And then there is no intention to close down the business. So that's the belief that every single business must have. Yeah. If you want to start a business and then you say to yourself, I want to start a business. Let's say I'm probably not going to survive after 5 years. So we cannot let that happen. Yeah. So going concern is the belief of the business that will continue to operate for indefinite future. That is the principles that must be applied in the business. Yeah. Next, materiality. Remember this materiality, it is rarely questioned, but it's been questioned for several times, but not always, yeah? So look at the word material. Material is not raw material, yeah, as it is raw material. No, it is not that, okay? Pay attention. Materiality is about significance. Okay, significance. It means it is important or not. That is materiality. Okay, for example, assets that have a useful life for more than 1 year, but the value are not significant or material, they will be treated as expenses rather than non-current assets. Now, look, asset that have a useful life more than 1 year. We know by definition assets that has useful life of more than 1 year is called non-current assets. Yeah, because we can use it for more than 1 year. But when we look at the value, it is really cheap. It is not significant if this asset is missing or even damaged or broken. Yeah, it's not significant. So rather than we are treated that as non-current asset, because non-current asset will have a method to calculate the depreciation. We will study about that on chapter 12. Yeah. So rather than we going through all the process of depreciations of non-current assets, yeah, but the value of this asset is not significant. It is not really important to the business, even if it is lost. Yeah. So rather than we are record that as non-current asset, we will treat that as an expense. Yeah. Now the example is stapler. You know stapler, yeah? Stapler for the business. If you buy that stapler in Gramedia or bookstore, it probably only cost you 10,000 rupiahs or maybe 20,000 rupiahs. Yeah. But the characteristic of the asset, you can use it for more than 1 year. Am I right? But the cost is only 20,000 rupiahs. So instead of you going through all the difficulties when you are recording that as non-current asset, let's just treat that as an expense. So you will treat this stapler as if it is finished to be used after 1 year. Yeah. Besides, or we can ignore the fact that this stapler is still exists after 1 year. Yeah. So it called materiality principles, significance. Yeah. Now, even as it said here, even though it can be used for more than 1 year, it is still considered as stationary expense. We will record that as stationary expense. Yeah, because the value is not significant or it's not material to the business. Yeah. Clear enough? Do you have any question? No? Caitlin? Continue, yeah? Historical cost. Historical cost is about assets that will be recorded or must be recorded at the cost price or original purchasing price in the accounting books. Okay. What it means by the cost price or original purchasing price in the accounting books, it means must be recorded when it is purchased for the first time. Now, I want you to imagine your statement of financial position and make it for 3 years. Imagine in your mind, in your head, we have statement of financial position, and that statement of financial position is for 3 years. 2018, 2019, and 2020. Yeah. Now, look at after that. Have you imagined that? Yeah, imagine 3 years of statement of financial position. Now, in the statement of financial position, you have non-current assets. Okay. Imagine premises for your non-current asset. This premises will be stated and then will be showed in 2018, 2019, and 2020 statement of financial position. And the value of this premises will always be the same. Okay, so let's say this premises is purchased on 2018 for the cost of $100,000. In 2019, it will still stated as $100,000. In 2020, it is still $100,000. Now, what it means by historical cost, when you are preparing 2019 and 2020 statement of financial position, you must state the amount of premises, yeah, with the amount of purchasing amount when you first time purchase that premises, which is 100,000. Why? Because there is a situation, there is a case where actually the business, yeah, actually try to make the assets look bigger. Yeah, for example, the business will use market value of your premises and then place it in 2019. Yeah, does it happen? Yes, it happens. Even in Australia, yeah, their accounting books is doing that way. Yeah, but we called it as revaluation. But we are not using accounting standard of Australia. Yeah, we're not using Australian standard board. Okay, but we are using UK standard. Okay, so even though market value in 2019 of your premises that you purchase, which is 100,000, is bigger, then you cannot use that market value to increase your worth of your company. Yeah, because we have prudence principle here. We cannot overstating our assets. Yeah, so that is why the assets must be recorded when you purchase it for the first time, even though the market value is bigger than that. Clear enough? Let's say in 2019, your premises is actually 112,000. It's bigger because property price always increase, yeah? Except for the COVID pandemic before, when all properties are down. But in normal situation, property is always increase. Okay, clear, yeah? That is about historical costs. Next is accounting period. Accounting period, I believe you familiar with accounting period and you understand this better because we have studied this and we discuss this more often, yeah? Accounting period is the life of the business that is divided into accounting periods with intervals. Okay, now that intervals usually for 1 year. Is there any other intervals? Yes, which is 6 months or 3 months. If you are looking at the investment prospectus, okay, they will present you financial information within multiple range. Yeah, multiple intervals, 3 months, 1 month, 15 days, 6 months, 9 months, 12 months, and 5 years. Yeah. So intervals is about that, but we will study about accounting principles, the accounting periods for 1 year only, yeah, for your level. Okay. Wait a second, my MacBook is low bad. I want to charge first, yeah. Wait for 1 minute. Okay, let's continue. Any question until accounting principles number 11? No question? No, yeah? Those who I circle, yeah, which I circle here are the most common question in the IGCSE, yeah? So you must be able to understand that better compared to the others. I have question from Warren. For the historical cost, that is 3 accounting period for all 3 years and all listed in the same price for SOFP. The price in which the property is bought? Yes, correct, yeah. So in terms of historical cost, you will present the value of purchasing price when you purchase the goods, when you purchase the property for the first time. Okay, let's say you purchase it. Yes, the price will be the same for all the 3 years of SOFP. The price will be the same. Correct. Okay, the cost price. Okay, we will talk about depreciation later in chapter 12, yeah, Warren. Now, depreciation is another method in accounting for specifically non-current assets, and property is one of the non-current assets. Okay, when we present the cost, it will be the same, equal, but in terms of net book value from year to year of all those 3 years will be different. Yeah, will be different, the net book value, and it will be discussed more on chapter 12. But when we present the cost of the premises from year to year, it will be the same, the cost only, yeah? Clear enough? Clear, yeah? Warren? Okay, let's continue. Accounting policies. Accounting policies, as I said before, it's about rules on how presenting financial statements of the business. How we actually preparing income statement as well as statement of financial position. Accounting policies only 4. Yeah, only 4. And these are the accounting policies. The first one is relevance. The second one is reliability. The third one is comparability. And number 4 is understandability. Okay. Accounting policies that usually been questioned is only this one. Yeah. So back to the topic. Number 1 is relevance. What is actually relevant? Financial information provided in financial statements. If I say financial statements, it means IS and SOFP, yeah? Statement of financial position and income statement. Financial information provided in financial statements must be relevant to users. Of course, if you're giving information that are not relevant to the business, so what's the use of that information for us? Yeah, it means that it can be used to confirm, correct about the past events or transactions that happens in the past. Of course, financial statements is a report that has been going on during the past 1 year. Yeah, so all informations in income statement and SOFP must be correct and can be confirmed. Yeah, so that because all the informations are relevant and all the users can make business decisions based on it. Yeah. Next is reliability. What is actually reliability? Financial information provided in the financial statements must be free from bias and significant errors. Errors are not allowed in the financial statements, which is IS and SOFP. Okay, because our financial statements must be reliable, yeah, free from error and bias. Number 3 is comparability. Your financial statements provided must be able to be compared, yeah, so that we can make comparisons of performance in the business from a wide range of countries. Okay, if you're using method, you have to be consistent of using the method from year to year so that you can compare the performance of the business from year to year, or even compare your business with other business in the same year. Yeah, that is comparability. Next is understandability. Financial statements provided must follow standard presentation. That is why I say to you, when it comes to financial statements, you have to follow the templates of income statement and SOFP. That is the major rule. Yeah, you cannot use your DIY financial statements, your own template. Yeah, you cannot do that. Yeah, because we have to follow standard presentations worldwide, so that users in every other countries or nations can easily understand your financial statements. We have to follow that rules. Clear, yeah? So that it is understood by others. Yeah. Now, the way it presented are the same in every countries. Okay. Clear, yeah? That's about accounting policies. Any questions so far? No question? If there's no question, then I'm going to dismiss our class early. It's the first day of term 4. And I want to discuss this one when you have a better when we have a better time, yeah, longer time, because this one is quite need your concentration. Yeah, capital and revenue, expenditure and receipts, as well as inventory valuation. Okay, any question, guys?